So why does an investor have to maintain margins, and how does this protect and impact you as an investor? We already know that your share transaction takes 2 days to settle, but fortunes can change in 2 days in the market. The price of the share that you bought could move up sharply, and the seller may want to back out of the trade in the hope of getting a better price.
So how does the exchange ensure that all transactions are honored at the price they were struck? This is where the margin system comes in.
Basically, margin is, when we talked about the counterparty risk, clearing corporation is actually taking the counterparty risk. For the clearing corporation to take the risk, it has to ensure that it has a skin in the game from one of the parties. Both the parties who are trading that particular, executing that particular transaction have a skin in the game. So they need to, it's almost like performance guarantee. They need to put in some base level margin before they execute a trade. To ensure that people don't renege on the executions which have happened, clearing corporation collects margin upfront for every transaction which is happening on the exchange platform, and the margin is based, it's not a number which just is generated out of hat. It is based on the volatility in the market, and it is continuously recomputed based on the price volatility which is happening in the market. When the prices move up or down consistently, there is a significant amount of volatility in the prices, the margins shoot up because the risk of uncertainty has increased. To cover the uncertainty risk, the margins might shoot up.
Let's understand this with an example. If you buy 1,000 shares of a company at 100 rupees per share, the total amount that you owe your broker will be 1 lakh rupees. But despite a T+2 rolling settlement, you would first need to make an advance payment to the broker to lock this transaction. This advance amount is called a margin, and it is calculated as a fixed percentage of the total amount. So in this case, if the upfront margin payable is 10%, it would mean you will need to pay 10,000 rupees at the time of striking the deal. To help us understand the concept of margins better, we have with us Mr. Bhavin Parekh, Deputy Vice President, Risk Management at Angel Broking.
Thanks very much for joining us.
Thank you.
My first question is, what is the concept of a margin and how does this really protect the investor?
The margins are levied by the exchange. What happens is, let's say there are two counter brokers who are transacting in a particular deal. One broker is buying for a customer, another broker is selling for a customer. Assuming they don't pay the margin and exchange doesn't take any margin, and the settlement happens after 2 days. Till that 2 days, what if the broker backs out from their obligation? And if that broker backs out from the obligation, there is a chances that there would be a counterparty risk. To avoid the counterparty risk, exchange charges the broker the upfront margins. So, for example, if you buy 1 lakh worth of Reliance Industry, so exchange takes around 7,500 as VAR margin, which is 7.5%, and the balance margin is taken as extreme loss margin, which I'll explain you a little later what are these margins. But these margins are taken so that in case if the price goes down in Reliance Industry, the counterparty risk is been covered. Hence, exchange takes this margin upfront. Brokers are supposed to deposit this margin upfront with the exchange, and the exchange then only allows a broker to transact for their customers.
Can you explain how the margin is computed?
Margins are computed based on the volatility of the script, and there are 3 kind of script categorization which is done by the customer by the exchange. Tier 1 scripts are basically blue chip scripts, Tier 2 scripts and Tier 3 scripts, and accordingly the margins have been computed. There are 2 types of margins. There is a VAR margin and there is an extreme loss margin. Over and above that, exchange also takes mark to market margin. So in case if the stock goes down, the brokers are the purchase broker has to provide with the additional margin as well by the end of the day. These margins have been computed by the exchange on real-time basis. So whenever you transact into a particular script, if as a broker you had not deposited your margins with the exchange, then your order would not go through. So the margins have been calculated by the exchange, and all the orders which are executed by the broker, first the margins are checked and then the orders are pumped into the system.
So how does the price volatility in stock prices impact the margin amount?
The price volatility has a larger impact on the margins. When the price decreases or increases with a very high volatility, then exchange revises margins, and this revision in margins would impact the brokers as well as the customers in turn, because then they have to shed out more margins for any transaction that they do.
Okay. So you mentioned the different types of margins. Can you just take us through what are these different types of margins?
Sure. Exchange in cash market segment, they charge VAR margin, which is that value at risk margin, which is a scientifically calculated based on historic price movements, based on volatility. This margin, basically, what happens is, in case VAR margin is basically it covers 99.9 times risk on any given day. What it means is, out of 100 days, 99.9 times your margin would not get breached. Your volatility would not breach the margin requirement. But there is a chances that there is a 0.1% that the price movement would be more than the margins applied by the exchange. To cover that, exchange also charges extreme loss margin, which is a fixed margin, which is over and above the VAR margin requirement. And end of the day, whatever the price volatility happens, they'll mark to market the positions, and whatever M2M loss that has happened for the day, till the time the settlement happens on T+2, till the time settlement happens, exchange would also compute mark to market and debit the broker accordingly.
Okay, so whenever I make a trade as an investor, will the broker charge me a margin amount every trade I make?
Generally, what happens is, if you are on a sell side, if you want to sell your securities and your securities are already been lying with the broker, then a broker would not charge that particular margin. But assuming your securities is lying in other demat accounts and broker doesn't have the visibility, or they doesn't have the right to take the shares, they'll charge you this particular margin. But for every purchase trades, because of the broker's risk also, brokers would definitely charge the margin to the customer. Unless the customer doesn't keep a deposit with the broker, they'll not be allowed to purchase any securities. So that, unless the margins have been covered with the broker.
Okay, so basically, unless I have a deposit with the broker, only then will he not charge me margin. Otherwise, I will have to pay the margin.
Yes.